Welcome to wealthmanagement.com's Fast Chats. I'm Mark Bruno, Managing Director of the Wealth Management Group at Informa, and we are very excited to have a special guest here from Cambridge Investment Research. We have Kris Emick, who's first vice president there. Kris, it's been a little while, but so great to see you again, and thanks for coming on.
You as well, sir, Mark. I know we're talking and getting ready here. Definitely pre-COVID, the world moves fast, and our world has not slowed down, but good to see it even digitally at this point.
That is for sure. The world has changed a lot. And in particular, M&A has had a huge impact on the evolution of the wealth management space over the last couple of years and continues to. And that's our number one topic here today on this Fast Chat. I know that you've been very actively involved in a lot of the M&A activity that's taken place over the last couple of years, very involved in a lot of the M&A activity that's taking place right now in the industry. Maybe as a starter, Kris, Cambridge has been extremely active. If you could give our audience just a bit of an overview of what role Cambridge is playing in the wealth management M&A ecosystem, I think that would be a great starting point for our conversation.
Yeah, it's a great starting point. You're right. We really try and support and work in the M&A land in two different ways. I'm fortunate enough to lead a consulting team that helps our roughly 4,000 Cambridge financial professionals of Cambridge Nation across the nation, helping them through the entire process of succession planning or acquisition. And then secondarily, Cambridge has also been active as a buyer, supporting that effort as we look to grow the business. We've always looked at there's three ways to grow Cambridge: recruiting, organic growth, helping our advisors grow through practice management, coaching, and whatnot. And then the acquisition front as well, in terms of us being able to go in and buy smaller broker dealers, RIAs, large OSJ enterprises that want to join us. So we've really worked across both directions, both coaching and consulting our advisors on their acquisition goals, and then Cambridge's own.
Excellent. And now I've spent some time before my current role as a consultant in the M&A and the valuation space. So I know that there are so many different ways that you can conduct a valuation. And now with markets being more volatile than they've been at any point in the last decade, give or take, and so many other factors, I'm curious, Kris, when you're doing a valuation, what are some of the key considerations and factors that you're currently looking at?
Yeah, I think from a most macro sense, Mark, we're looking at clients' revenues and both history and forward looking. So in terms of the clients, we're looking at that segmentation of the client base. Are all the assets concentrated with a handful of folks? Are all the clients in their 80s and drawing funds down, and there's no planning for that second generation or third generation to ensure the assets stay with the business? Or is everyone in that younger skew and they're making ongoing contributions to retirement accounts? We're really doing analysis on the demographic of the client base, but then we're doing that same type of look at the revenue. What is the makeup of the revenue? Two outsized examples, is it someone that is 100% front-loaded VAs? And it's really about what they can accomplish in each given year, or is it a fee-focused, maybe using an asset mark, an SEI, a third-party money manager to help with the asset allocation and modeling? And they're focusing on the client journey. And again, looking at where those revenues are concentrated. Is there a consistent year-over-year track record that we can look at? Are they growing at 25% on average? Are they growing at 3% on average? And really looking at those three key demographics and three key segments of valuation, but then looking at, okay, we've done that analysis. Now, how are we going to actually value it? Rule of thumb for forever in our world has always been, well, it's just 2 times revenue, and that's what it's worth. Right. And fortunately, I think as wealth management and M&A inside of wealth management has matured, our methodology for valuation as an industry as a whole has changed. We've really started to look at not only top line multiples, but really looking at cash flow. Now, whether that be discounted cash flow and coming up with a discount rate to discount those future expected revenues, or really looking at a multiple of EBITDA, a little bit of that in my mind, Mark, is just beauty's in the eye of the beholder. Everyone has their preferred methodology. I personally feel that it's a lot easier to manipulate the discounted cash flow, different assumptions around what you think the terminal rate is, assumptions around the the free cash flow. I'd rather look at it as a multiple of EBITDA and really look at not only what is revenue minus expenses equals net income and add back, interest, taxes, depreciation, amortization, but really look at those outsized expenses that really looking to normalize EBITDA. And if you had a big marketing spend one year that's not going to be ongoing, or you've hired an attorney to help you with your succession plan, or, I know you and I both know Dan over at Echelon very well. Those folks, that's an outsized expense that's not going to continue on into the future. So how do we look to normalize cash flow so that we can get using the past history and a realistic projection of the future growth of the firm to really look at what is a realistic cash flow and then look at valuation from that standpoint?
Yeah, and that's a great way to look at it. There are so many different ways of valuing companies across the board, right? But in the wealth management space, EBITDA really has become the most sort of commonly or most frequently used metric. I should ask, more just for a current sort of state of the state. When I look at the M&A market, one of the biggest sort of external factors that has influenced it has been obviously the increase in interest rates. Yeah. I'm curious whether you're doing valuations or when you're looking at M&A activity with interest rates being as high as they are now, what net impact has that had on both activity levels and the way you're doing valuations?
I don't know that it's changed our valuation yet. I would tell you anecdotally, just looking at the marketplace, there was a fairly big slowdown when the Fed got as aggressive as it did in the very beginning, and we were seeing 75 basis points every month. And your capital stack went from 4% to 10%. There was a pause, I would say, in the marketplace. We haven't seen it impact valuation yet. I personally feel we're probably in step 2 of 3 when it comes to this. When we were in COVID times and money was artificially at 0 and, banks were lending at 5 and 6. And if there was a seller held note, they were carrying it at AFR of 75 basis points, 100 bips. We were really seeing extremely large down payments, very short duration seller notes, maybe 18 months to 36 months, sometimes even without any type of valuation adjustment if clients or revenues changed. Because during that time, money was so cheap and the markets were on such a tear that buyers were willing to take that risk. And the small change that I think we've seen now, Mark, is that sellers have been more willing to extend the duration of their held note, or the escrow amounts have gotten larger. Buyers have been more demanding in terms of what they want in terms of those protections for them as buyer, revaluation clawback language. But we haven't seen a pivot in the valuation yet. I know the world is talking that we're on is it a pause? Is it a skip? What's the new Fed language we're using this month? But if we skip this month and we skip a number of months and we start to then lower interest rates again, it'll be interesting to see how that changes in terms of deal making. The converse to that, and where I think step 3 might go, is if the pause or skip turns into a future rate increase and continued rate increases, I think that has to have an impact on valuation. Really for no other reason than we are a cash flow business. Most wealth management houses don't have large fixed assets that folks can lend against and use as collateral. And it's really about the cash flow of the relationships with the clients. So in that vein, if cash flow is finite, unless there are large changes that a seller is willing to concede in terms of staffing and future expenses to the buyer, if the cost of capital gets bigger and the cash flow is finite, then the only thing that can change is the price and the valuation. Mm-hmm. So I think it'll be interesting to see over the next 6 to 12, 18 months what happens to rates and how that impacts not only valuation, but deal making.
Yeah, it's very interesting. I think you make a lot of great points there. We're just fresh off of our RIA Edge annual conference, and this topic came up quite a bit. And headline is the valuations haven't changed much, but the deal structures have, right? So that makes a lot of sense. And your view into the future, whether it's a pause or a skip, right? We'll see, right? But there could be some more substantial changes on the horizon. One other, factor that I think we should spend a moment on is obviously there's been a lot of capital that has been coming into, the wealth management space over the last, 4 or 5 years. Private equity in particular has been very active and has seen a lot of opportunity in the space. What role do you see private equity potentially continuing to have, right, on M&A activity and valuations in wealth management?
Yeah, I've always been fascinated by this. Private equity, in my mind, it's like water. They will find a path, and they're always looking for a path toward great cash flows. And it took them a while to figure out that our industry has wonderful margins and cash flows, but like water, it found a way. So in that vein, I don't see private equity going away. We are a wonderful business. We do get to enjoy great cash flow and enjoy great client relationships. And firms that have really focused on growth have really used that war chest that the private equities bring in, whether it be minority interest or majority stakes, holistic takeovers of the firm from a private equity standpoint. It's really been an infusion of cash for them to then grow their business 2, 5, 10-fold very quickly. I think what's been interesting to me is we've seen that jet fuel come in from the private equity funds. And a lot of that was built around, again, 4 and 5% interest rate on their leverage. So what, if any, impact will their ability to continue investing be impacted by this doubling of their capital stack? If assumptions get built off of 5% money and suddenly you're at 10 and 11 mezz debt type of rates, that has a complete impact on your forward-looking assumptions for what you're investing in. So I don't think they're going to go away. I think much like deal making, between two RIAs has changed when it's owner to owner conversations. I think that private equity to investment opportunity conversation is changing as well in terms of caveats, protections for the private equity as buyer, and assumptions around growth and really the growth rate, because that capital stack has gotten more expensive. But again, they're not going away. And that's probably a good thing for our industry.
Yeah, I would agree. Definitely not going away. That is for sure. And I think the final question I had for you, I know we've talked a lot about some of the external factors that have been influencing M&A. But it would be really important to go internal, right? And look at how advisors are managing their own businesses, right? And their own plans. And it's funny, before, we got online here, I went back into the archives and I had done a research study with Cambridge in 2012, right? So 11 years ago, we focused on succession planning and continuity planning. And I looked at it because I wanted to get a sense for, 10, 11 years ago, how many advisors or how many owners actually had a succession plan in place? How many had a continuity plan in place? And it was roughly 35, 40% had continuity, 20, 25% had succession. And here we are 10 years later, and not much has really changed, right? So maybe we can spend a moment on that. I mean, why do you feel like that's where we are, right? And it's still this relatively low, let's call it adoption rate. And two, more importantly, why is it critical for an advisor to have a continuity succession plan in place?
The easier of those two questions, Mark, is why it's important.
Yeah.
Wealth managers, investment advisors, registered representatives, financial professionals, whatever you want to call them, their entire life's work is built around planning for their clients, and not only growth, but protection. And that protection is vital for that family's ability to pass money to next generation, pass money to heirs, set a legacy for whatever someone's wealth goals are. And a financial professional does a fantastic job of planning for that client. It's the same thing when it comes to continuity and succession planning for a financial professional. You're guarding not against what you expect to happen, but the what if. And guarding against the what if allows the client to have peace of mind. And as we work with some of our starting to chronologically advanced financial professionals, talking with them about their continuity planning Some of them are fearful to bring it up to their clients because they see that as them admitting their mortality, or that the client will think, well, geez, they're not going to be around that much longer. I need to go find somebody else. But in reality, most clients, when they learn that a financial professional has their continuity plan in place, even if I went so far as to say, hey, if anything happens to me, Mark's going to be the one to take over your financial journey. The client wants that peace of mind, much like they want their own protection. They want to know that their wealth management relationship is protected as well. So I don't know if I'm kind of answering both things at the same time here. I don't know if it's fear of mortality, if it's the cobbler's kids have no shoes, so they're busy planning for their clients and not planning for themselves. But it's a vital piece of someone's business to know that their heirs, the financial professional's heirs, their spouse, if they're trying to do a charitable gift at the end of their career, that those things are protected, and continuity helps that. Mm-hmm. It's the guard against the what if, and the thing that I wish, you quoted that number, Mark. It fascinates me that 2012, it was 35-40%. I think it was a Schwab study just a couple of years ago. It's still in the low 40s. Mm-hmm. We spend so much time at Cambridge talking about it, and we're in like the mid 50s from a percentage standpoint of folks that have a continuity plan. So I don't know how we get us over the hump, but we need to get there, and we need to do more of it. It's that thing that protects against the what if, and man, I wish more folks would do it.
Yeah, and I think it's not the why. I think people understand that. It's the how sometimes.
Yeah.
And implementing and executing it is not difficult, but it's time consuming. And I know Cambridge obviously offers a lot of resources that helps your advisors do that. And there are obviously a number of other avenues that someone could pursue a continuity plan, but you've done some great work at Cambridge. So just want to acknowledge how easy you've made it for your advisors, and the fact that the majority of your advisors do have a continuity plan in place is something to celebrate. So congrats. And hopefully when we do this again in 10 years, we see the needle move a little bit. But with that, Kris, thank you for taking some time out. I appreciate it. There's so much that we could cover when it comes to M&A evaluations and continuity and succession planning. But to be able to do it as succinctly as you did in this fast chat is really impressive. It was great to connect with you again, Kris, and thanks for stopping by this wealthmanagement.com fast chat.
Great to see you as always, Mark.